Now let's look at the European stock market. So first off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we have, the European stock market here. So Europe, we have a 43% move here from the low, and we are at the highs. VGK is the ticker. So we go here and look at the charts. Weekly data points, and this is all the data we have here. So I have drawn in the time cycles, and you can see that there are some really nice time cycles here. And I also have drawn in some of the previous low to high rallies. So if you make it even more exact, like that, then this was, 113-ish% move from the low after the financial crisis. And that was over, 784 days. But, we did have some sizable correction within here. But yeah, as far as, from the low to the high of the cycle, time cycle, then yeah, that was the move. Then in this cycle, you have a 67% move, rather similar time frame, 749 days here, 784 here. Though in this instance, we didn't have any major dramatic correction in the middle of the rising phase, like we did here. In this instance, a much more modest move, 51%, no dramatic pullback. And then we have, the current move, which is 94-ish% from the low, 455 days. So the trend here is that we see that when we look at the days, the duration of the move to the upside, it's getting lower. 784, 749, 581. Then so far, it's 455 days. So there certainly is, it's taking less time. However, the percentage move here, current move, is starting to rival the move we had here, from, the bottom of the financial crisis. Here we measure the breakout move, so how much taller was this cycle peak versus this. So here it was, 10%. This cycle peak was only 3%-ish above the previous cycle. And so far, the current rising phase is at 9%. So it is on the historical high end. That's rather relevant. If we look at the current weekly RSI, this is definitively one of the highest RSIs we have ever had for this ETF. Yeah, I mean, you can see it quite clearly yourself. This is really, really, really high. When we look at the PPO, we see something similar. The current PPO is the highest we have ever had. And the PPO, it measures the distance between price and the red 200-week moving average. When we compare the cycle with the seasonality, we do see that June is the weakest of all months, and this is all the data we have here. So clearly there's something off with June. July and September are some of the strongest months, but yeah, the current month it is just factually weak. So basically, looking here at the weekly data points, we have gone very, very far. Historically, compared to the previous rising phases, we are either, we are basically close to the peak, based on the historical data. If we go here to the daily data points, we do see on the PPO, which measures difference between price and the 200-day moving average, we are at an extremely high level. Previous times we had these high readings, we did at least see a pullback to the 200-day moving average, and in other instances we had substantial, far deeper pullbacks, far below the 200-day moving average. So yeah, the bulls are really pushing it. Going here to Finviz, we are way above the trend channel, which is not bullish. Here it is bullish. These are good risk-reward buying opportunities. If you look here at the history, many times when we have pushed at the upper end of the trend channel, there's been rejection. When we go here to and compare, the S&P 500 with the VGK, looking at the price earnings, then we do see that Europe is 6% below America, so it is somewhat cheaper, but 21-ish price earnings is not historically cheap. Looking at the dividend, it is enticing. We do have a 2.4% dividend. That is juicy. That is the kind of dividend where it makes sense to even hold through some kind of rocky periods. The problem with the VGK, the Europe ETF, is that even throughout an overall bull market, it will have very substantial corrections. Like this pullback here, as an example, was 30%. Many would call that a full-blown bear market. In this instance, we are also at a 30% pullback. From this high to this low, it was, approach, minus 44-ish%, which, the dividend doesn't fix those kinds of damages. But due to the very clearly cyclical nature of this ETF, this market, it is very obvious that this is one of those that it makes sense to buy low and sell high. We currently are not at a low level. We looked at the cycles, we looked at seasonality, we looked at price earnings, a bunch of stuff, and they tell a consistent message. The RSI, the PPO, this is the very late part of a rising phase. The easy gains were made far lower. So let's actually illustrate, the alpha that you can generate by buying low and selling high, because it's a really big deal. So here if you, let's say that you buy here and sold here, like hypothetically, you got in early, but you also got spooked out early. So the move from that level to here, that is, 27-ish%. So even if you hypothetically were to just get shaken out early because, it's getting overvalued, then you would still have more alpha than those who bought in later, because it is much more difficult for the security to make a move later than it is early, because this is from a lower level. So this is one simple way to illustrate how buying low, it generates a lot of alpha. Yeah, and there's tons of other examples, of course. Let's compare the ETFs a bit further. So if you look here at the holdings, here are some of the top companies in the S&P 500. Here we have Europe, Roche, Nestle, AstraZeneca has certainly been in the news, Sanofi, Siemens. So here we see the sector breakdown. Finance is on top here in Europe, though we do have a rather nice balance here between the sectors. Also a nice balance in America. More balance here between market caps in Europe than USA, but definitely heavily tilted towards the large caps. So if I were to sum up my take here for Europe, this is clearly, based on all the data, we are at the very late part of a major rising phase, which is part of a time cycle. The time cycles have been very consistent. The European stock market makes a lot of sense to buy low, but due to the very substantial corrections it likes to have, which were, around 30%, or worse, you definitively want to be nimble when it starts to correct. June historically is the weakest month. It could be the month that marks the peak. It's obviously hard to be certain of that, given the massive liquidity we do get from the central banks and other parties. But the history is what it is. The facts are what they are. The key thing is to be very, very nimble.